Welcome, everybody, to the Introduction to Market Efficiency module and mini course. Thank you for joining today. My name is Dr. Bryan Foltice, and I'm Associate Professor of Finance at Butler University. And my passion is to teach people about behavioral finance. And this module is going to look at financial markets, and it's with an idea of answering the question of, are markets efficient? And what you're going to learn is that this is not a yes or no question that can be sorted out in about a 5-minute video. We actually have an entire module and series of videos devoted towards trying to get you to better understand and then to answer the question on your own terms on how efficient you believe markets are. And when you have that belief, then you can actually bring that into your own trading strategy. And that'll ultimately determine how active you want to trade with actively traded funds, or if you want to be a passive investor trading mostly in index funds. And so we're going to go ahead and get started straight away with the introduction in this video. And the way we set this up is we go all the way back to classical finance, and we think about how classical finance determines efficiency and how we price particular assets. In this case, we're going to be looking at stocks and equities. When we go back, if you've had any finance classes or done anything in the area of finance, you may have heard of the capital asset pricing model, or CAPM. Just to give you background here, CAPM, capital asset pricing model in the 1960s. And what it gives us an expected return for a stock or a portfolio equals our risk-free rate plus beta, the return, the market, my risk, all of that laid out here. This is what we call the market risk premium, the return of the market minus our risk-free rate. This premium that we would have in order to take stock exposure and be in the stock market. And then our beta measure, you have to go all the way back to your finance classes. Remember, our beta measure captures systematic risk. This is our systematic risk. We're going to talk about that. And then we make sure we have this risk-free rate. So what we see here on a chart is on this Y graph, our risk-free rate here, whatever that is, and then follows this nice, pretty straight line. And this is 0, and the x-axis, and 1, remember, is the actual market. So our benchmark, sometimes the S&P 500, or whatever benchmark we're using, has beta of 1. And we capture system risk. Okay. So we have systematic risk, and we also have something called unsystematic risk. Those are the two different terms. Non-systematic risk and the way I like to teach this is systematic risk are risks that affect the whole system. So when we think about taxes, that affects the whole system. If we think about inflation, that affects the whole system. Economic growth or lack thereof, that'll have very widespread effects on the whole system. Those are the systematic risks. And it's captured in beta because we can't run away from it. We can't diversify away from systemic risk. Can't diversify away. And no matter how smart you are or whatever, how much talent you have in your trading, you can't run away from this systematic risk. Therefore, it's captured in beta. Non-systematic risk are risks that affect different industries or different companies. So somebody has accounting problems or something that's isolated, bad recall of tires that is isolated to either a company or at the broadest level, industry. That's non-systematic risk. And what we believe here, non-systematic risk can be diversified away. We can live risk with proper diversification. Don't put all your eggs in one basket. Proper diversification. Spread them out over different companies, over different industries, and we can just diversify that. Non-systemic risk. Everything else. Systematic is captured. Property risk. So when I think of beta risk, just to give you this idea, high beta stocks. These are stocks that will be highly influenced by the systematic risks. If we have a good economy or a bad economy, some of the stocks like we think Tesla or Apple, somebody buying cars or new iPhones, will be in a good environment or a bad environment. So that's going to have a high beta. And anything higher than 1 is riskier from a systematic basis than the overall stock market. Anything less than 1 is obviously going to be less risky from a systematic risk standpoint. We fall anywhere on this. So when I think of Duke Energy or another energy company, we think about, in a good economic environment and in a bad economic environment, still going to have lights on. And it's not going to fluctuate my electricity bill. It's not going to fluctuate that much based on good or bad economic conditions. So that's how I like to think about it here. And based off of this, we have a nice clean model that we can just come up with the expected returns for a particular stock. And the way we've gone all along here is all stocks should fall on this line. We all are rational investors. This should never deviate. If it does, anybody wants to be stupid enough to step out of this line, those dumb money that we would call it would just step out of that and would get arbitraged away, and we get right back into this line. And so the value of a should be worth the value of a is what a security should be worth. Do careful analysis. Security is worth after analysis. And the price is what the market says it's worth. Market says it's worth. No, now we have value and price. What a security is worth after analysis. And the price, the market says it's worth. Classical finance, that's value equals price every time. We should have no disagreements on what the market is worth and what the security is worth after. Classical finance says price, value, always. Price equals value, always. Behavioral finance. What we end up finding here is, yes, price equals value. Most of the time. And I think that's an important point to make here, that we do believe that it's not a free-for-all here in the markets. We believe that price equals value most of the time. Most. But here's the catch. We've got some questions. Most of the time, but we have questions. And those are the questions that we're going to find here and that we're going to unpack. Question. And that's the questions we're going to try to answer here in this. Thanks for joining on this first video here. And we're going to keep rolling as we move forward. So thanks for watching. And let me know if you have any questions. We'll see you in the next video.